Well, thank you, Kayla. So I was saying, welcome to tonight's session. This will be the last session for the weekly classes, and then we will start our revision program. Tonight's class will be around 45 to 60 minutes. We will just go over a high-level overview regarding mergers and acquisitions. Most of the calculations is done in valuations, which we have covered already. So remember, the revision classes will move to a weekend, so Saturday morning, most likely. The reason being for that is I need to push the revision class slightly longer. So it needs to be about 2.5 hours to 3 hours. So I don't want to do it on a Thursday evening. So I'll do it on a Saturday morning. So it'll be nice and fresh, and we can cover at least a half a paper. So I'm looking to cover about 1.5 to 2 papers with you. Each paper is 100 marks, so therefore we cover 50 marks in each session. So we need about 3 hours. So I'm going to move it to a Saturday morning starting next week. Just remember that to date, we have covered capital budgeting, we have covered cost of capital, we have covered sources of finance, we have covered working capital, we have covered what else did we cover? We covered financial analysis. We have covered valuations, okay? And we covered, I think, strategy, risk management, and governance as well. So we've covered all of those topics. Now, part of valuations, or somewhat part of valuations, is mergers and acquisitions. Mergers and acquisitions in the real world is a complex subject matter or complex topic. And what we cover is literally the very, very basics of mergers and acquisitions. So we'll go through the basics, and then from next week we will work through. So I'll send out a schedule of what we will cover when. So each session, which question paper we'll cover. So I'll tell you which question paper and which question we will cover. And then I'm going to give you homework that you need to do, which is a different question paper, but of the similar topics. So that's what you will do. So you cover one with me and you cover one on your own. I'm still busy marking the stuff you sent me. I'm almost about halfway, and then I will send it out. I'm hoping to finish it this weekend. Otherwise, next week before the revision classes, I'll send it out. So you will get some feedback on that. Okay. So that is just some kind of logistics, and so you know where we are. So for tonight, we see we're going to cover mergers and acquisitions. I'm going to cover it very high level, because it's not from on an undergrad level. It's not, you don't need to know that much. When it comes to CTA, is a little bit more, because the only thing you need to know from an undergrad is really valuations. Okay, so but just to give you some kind of overview and background, just in case they throw in one or two of those type of questions at you. So what you must know, the way I look at it, remember, it's not necessarily exactly like this, but the way I look at it is you have theoretical questions and then you have calculations, okay? Numbers questions. Now, under the theoretical questions, there are basically 4 issues that they like to test, or that you kind of need to be aware of. So number 1, it is, what is mergers and acquisitions? So you need to distinguish between a merger and an acquisition. This must not give you sleepless nights, because if it does come in, it's probably 1 mark, okay? But just so you have some idea, a merger is when 2 companies come together and form a new third company, and acquisition is when 1 company acquires another. So for example, let's say ShopRite and Checkers comes together and they form a new company. Or what actually happened, ShopRite acquired Checkers. So that is an acquisition. So an acquisition is where ShopRite acquires Checkers. A merger is when ShopRite and Checkers come together to form a new company. Okay, so that you must kind of know. Just another aspect to know is to know what is a vertical integration, what is a horizontal integration, and what is a conglomerate. A conglomerate is where a company acquires any company, right? So, for example, if we all may know Warren Buffett, and his company, the name of his company is called Berkshire Hathaway. Now, Berkshire Hathaway, they are a conglomerate because they acquire any company. You know, so they have insurance, they have they have insurance companies, they have some tech companies, very minimal. They have candy companies, they have railway companies. So you see, there's no specific type of industry or something. They just acquire any type of company. Okay, so that is a conglomerate. There's no specific link. Then you have something known as a vertical integration, and an acquisition or merger that is a vertical integration. A vertical integration is just basically going either a downward integration or an upward. So if you think about this is not a good example, but just to bring it closer to our minds, if you think of Coca-Cola, a vertical integration downwards would be where Coca-Cola acquires its customer. So a customer of Coca-Cola is Pick n Pay. So if Coca-Cola acquires Pick n Pay, that is a vertical integration. They're buying someone along the supply chain, okay, but they're going downwards. So if Coca-Cola buys someone after them, that is their customer. If Coca-Cola buys someone before them in the supply chain, for example, a bottling company, in order for Coca-Cola to sell Coke, they need bottles. So they have one of two choices. They either have their own bottling, or they buy, or they use a third party to do their bottling. So most beverage companies don't have their own bottling facility. They will use a third party. Okay, so they might say, you know what, to have more control over it, let's buy a bottling company. So they would acquire. So that is a backward integration. So you have a forward integration and a backward integration. A forward is where you acquire your customer. A backward integration is where you acquire your supplier. That is a vertical merger, whatever you want to call it. Then a horizontal merger is where you acquire someone in your own industry. So like, for example, ShopRite acquired Checkers. ShopRite and Checkers is in the same industry. So that is a horizontal. You're in the same line. So who's in the same line? ShopRite, Checkers, Woolworths, Spar, Pick n Pay. They are all in the same line. So if any of them acquire each other, that would be a horizontal merger. A vertical merger is where you acquire someone along the supply chain. So you have two ways. Backward, you are acquiring a supplier, or forward, you are acquiring a customer. Now, that just to give you an idea. Okay. So that's the first aspect. The second and third aspect is the most important ones. Okay. So what is the importance of a merger and acquisition? Why mergers and acquisitions? So remember, a company can expand in two ways. They can grow in two ways, either organically. So for example, ShopRite opening up more ShopRite stores, that is organic. Coca-Cola making another product or another flavor, that is organic growth. They're expanding from within. They're growing their business or their product lines from within. When we did organic growth, we applied capital budgeting principles. Okay. Then you have another form of growth, which is inorganic or unorganic, known as mergers and acquisitions. Okay. So where you acquire another company or you merge with another company. Now, what would be the reasoning around this? There will be some strategic reasoning. So for example, you may want to enter into a new market, or you want a new product line, or you want to have you want to have a new geographical presence. And it just may be, for some reason, it just makes more sense to actually acquire a company as opposed to start one on your own. So for example, let's say, like if you look at the, so I'll give you two real world examples. So Life Healthcare is a listed healthcare company on the JSE. So for a Life Healthcare is in hospitals, right? So they have hospital facilities. Now, the way a hospital can expand is by increasing the number of beds. Now, to increase the number of beds in the hospital, they can't just put in number of beds. They need to seek government approval. So every time they want to put in a new bed or additional bed, they need to seek government approval. Okay, so that is how they can expand organically. Another way they can expand is by offering a different service. So for example, if you read different, if you read maybe life healthcare, or you read Netcare, what's the other ones? Mediclinic, right? If you read them, they're all in the hospital business, right? Hospital facilities. So the way they differentiate themselves is by the services they provide. So for example, let's say Life Healthcare only have a heart and a radiology thing offerings. Now they want to expand into gynecology, right? So in order to open up, they call it wings, generally a wing or a unit, whatever you want to call it. So you want to open up a gynecology, whatever the proper term is, unit. You can't just open it. You have to seek government approval, so you have to go through all of those type of things. So now, if you want to expand internationally, you can go open up for scratch, but the chance of you starting in 1 year is really, really slim. You need to first seek approval for this. Before you can even seek any approval, you first need to build relationships with government and so forth. So an easier way to actually just expand geographically is to acquire an already established hospital. Let's say, like for example, Life Healthcare expands into India. You buy an established hospital in India as opposed to starting one from scratch. So that is a make valid reason. Okay. Another example, real world example, is the beer industry or alcohol industry. So for example, a few years back, AB InBev, which is one of the world's largest alcohol or beer company, they acquired SAB Miller of South Africa. And the reason for that was there were various reasons. One of it was the brands that SAB had, AB InBev wanted access to that. Another reason was AB InBev wanted access to the African market, and SAB Miller had a good footprint in there. So AB InBev could start from them scratch, but why not buy already an established company? So it is like the type of beer, it is the brands of the beer, it is the footprint that AB InBev had, and then another important one is the customer base. So when you look from a strategy point of view, you will look at from a geographical point of view, whether you are in developed versus emerging markets, and then also the type of customer. Who are your customers? Do you mainly have baby boomers? Do you mainly have millennials? Do you mainly have the generation X, Z, whatever they call them? And you want to get into the millennial market because based on research, the millennial market is the new baby boomers, meaning the millennial market is in the age gap group where they are earning the money, and as a result, they are making the spending. They are the ones spending. So if you want to make money, you need to go where the money is. And who has the money? The millennials, because they are the ones in the working positions. They are the ones that is earning the money and spending the money. They are the ones building families, so they need housing, this, that, all of those type of things you consider. So when you look at your customer base, you want to have a look, who is your customer base? So if you just focused on baby boomers, you're going to die because they are phasing out now, and millennials are the new big customers, and as a result, you need to make that shift. So you can just buy a company that already has it. So for example, like when AB InBev bought SAB, there was various reasons. Like I said, the beer, the brands, the footprint in Africa, and so forth. And another reason also, this is when I was following the AB InBev merger. You follow MoneyWeb, Fin24, whatever it was. So I was reading what asset managers or analysts was saying. So this one analyst was saying that in the beer industry, even if you are a big player, according to their research, whatever research, it tends to be that locals prefer local beer. So for even if a big brand comes in, it is difficult for them to steal market share, because firstly, they need to first people need to familiarize themselves with their brand, with the new brand, and then also this international company needs to work on the taste of the beer. And so because of that, it takes a long time for you to actually gain market share. So a better approach is to buy an established company that has the beer that the locals love already. So those are reasoning why mergers and acquisitions. So basically, so you can expand, and there are strategic reasons for those type of expansions. So that, just keep that in mind. That is a typical question that could come up. The third aspect is why mergers fail. Now, this is a big, they ask us quite often, can be like 5 to 10 marks, why mergers fail. So according to McKinsey, I read 2 reports, McKinsey as well as KPMG. I can't remember what was the date of the reports, but both McKinsey and KPMG came to the same numbers, okay? Basically, according to research, so 80% of mergers and acquisitions fail. 80% fail. And there are various reasons. The typical reasons that mergers and acquisitions fail, you'll find actually in your textbook. And when I read the textbook, obviously textbooks, maybe I just thought maybe it's a theoretical thing. Then I went to read out. I Google searched, and then I found it. And then it was, so what you have in your textbook is basically the real reasons that mergers and acquisitions fail. So typical examples is, in the concept of mergers and acquisitions, you will hear something as the following: 2 plus 2 equals 5. 2 plus 2 equals 5. We know 2 plus 2 equals 4, but they are saying a merger and acquisition, the value of a merger and acquisition is greater than the sum of the parts. Okay, so sum of parts 2 plus 2, but the merger is greater than that. So that extra 1 that you get is basically known as synergies. So just on a very basic level, it's a lot more complex than this, but on a basic level, let's just say, like, for example, when ShopRite acquired Checkers, what is the synergies? The one is that obviously one of the main reasons that ShopRite acquired Checkers is the market they wanted to enter. ShopRite obviously was targeting the lower end of the market, where Checkers is more on the middle end, right? So that is why they acquire Checkers, so that they can target those customers. Okay, so that is how so they're basically growing their market share. But other reasons for synergies, so let's say when ShopRite acquires Checkers, they may not necessarily need 2 accounting departments. They may need less than 2, right? So they get rid of some staff. Same with the IT department, same with a head office, same with marketing and so forth. So those are certain costs that they save on. Still 2 companies together, but they don't need all of those staff. Another reason, big reason, they now have buying power. As opposed to ShopRite and Checkers going separately to Coca-Cola, to Tiger Brands, to Unilever, to Nestle, to buy products, they now buy as one entity. So obviously their power is stronger, so they can negotiate better prices. So if you see things like that, will result in synergies. Now, synergies is one of the benefits of mergers and acquisition, right? But it's also one of the main reasons mergers and acquisitions fail. And the reason for that is, in many cases, management overestimate synergies. Because they overestimate synergies, the price they pay is too high. And as a result, the merger fails. Okay, the M&A fails. Another reason, which is a big reason, sometimes for M&A, makes completely sense, make complete sense. Okay, the price was right, everything is right, but in order to actually achieve what you want to achieve or you intended to achieve, you need to actually execute on what you wanted to do. So they call this post-implementation, okay, or post-execution of the M&A. And in many cases, one of two things happen. Either post-execution don't take place, or it does not take place in the time frame that was required. And as a result, the M&A fails. So those are two big reasons. Other reasons is lack of management fit. Just think about this. Let's say Pick n Pay and ShopRite have a merger. They can never, but let's just say they do. They come together. They create a new company, and both boards remain. Okay, now they need to make a decision, and it tends to be that the management of ShopRite wants to go with option A. The management of Pick n Pay wants to go with option B. Which one do they go with? If you go with A, it's going to appear that that ShopRite is stronger. If it goes with B, it's going to appear that Pick n Pay is stronger. Now we're dealing with people. Management is people. They are humans. They are emotions. They are egos. So because of those clashes, instead of focusing on the business, they focus on the egos and who's right and who's going to be better. And that causes the M&A to fail, just because leadership is not united and they're fighting amongst each other, whether you're aware of it or not. This is not fairy tales, this is real stuff, okay? So that is a reason. Another reason would be just simple lack of business fit, which is basically lack of business fit just means that you acquired a company and it actually didn't turn out to be as you thought it would be. So for whatever reason, the businesses don't just gel together. Okay, so those are typical reasons of failure. So like we said, overestimating of synergies, post-execution of or post-implementation of an M&A is not done at all, or not done properly, or not done in time, lack of business fit, and lack of management fit. Okay, so those are typical reasons. You can go read your textbook, there's some more. Those are the big reasons as to why M&A fail. So we covered so far under, like I said, I call it theory and calculations. So under theory, there are 4 things we dealt with. What are M&As? What is an M&A? What is an acquisition? And we spoke about conglomerate, vertical merger, horizontal merger. Under vertical merger, you have backward integration and forward integration. Then we spoke about what is the importance of M&As. Then we spoke about why M&As fail. And like I said, 80% of M&As fail. And lastly, it's to deal with legal things. Okay, so with every M&A, or yeah, I think with every M&A, you need to obviously meet the Companies Act. Definitely with every M&A, you need to follow the Companies Act. But what I was getting to is that before there can be approval, the Competition Commission needs to approve. So for example, when AB InBev acquired SAB Miller and the 2 companies had an agreement, they had to first wait on approval from the Competition Commission, okay? Similarly, when Walmart, so the large retailer in America, when they acquired Massmart here in South Africa, Massmart is the company that owns Game and Macro and so forth. So when Walmart acquired Massmart, they had to first had to obtain the approval from the Competition Commission. Okay, so that is always going to have to take place, and then obviously the Companies Act needs to be complied with. Okay, so that is your theory aspects. Now we come to the calculation aspects. There are 3 aspects under calculations. In no particular order. Number 1, valuations. Now remember, we already covered valuations in a previous lesson. But like we said, the valuations you need to know is the discounted cash flow or the free cash flow, the dividend growth model or the Gordon growth model, the earnings multiple. The earnings multiple that you need to know is known is the PE multiple or the earnings yield. Remember, PE multiple and the earnings yield is basically the same. One is the inverse of the other. So if you can do PE multiple, you should be able to do earnings yield. And then you must also know net asset value method. Then the other one, which is not really a valuation method, is market capitalization. Now remember, in WAC, we covered dividend growth or Gordon growth, whichever one you want to call it, and then we covered market capitalization. In the valuation lecture, what did we cover? We covered we covered free cash flow, we covered or discounted cash flow, and we covered what was the other one we covered? The PE multiple. Okay, the net asset value we also briefly covered. So that is valuations. Okay, when we do the revision class, we will go through all of them again. The second aspect that you must be able to deal with is how do you fund, how do you finance an M&A? There are two ways to finance an M&A, either through cash or through a share exchange. So you can fund an M&A either through cash or through a share exchange. Now, when you deal with a share exchange, we need to work out an exchange ratio. We hardly get tested that, but I'll try to find one, and so we can see a share exchange. But basically, you need to determine an exchange ratio. So, for example, when Shoprite acquires Checkers, and let's say it's a share exchange, it means Shoprite is going to give Checkers Shoprite shares in exchange for Checkers shares. So now Shoprite owns Checkers, but the previous shareholders of Checkers will be shareholders in Shoprite. So that is a share exchange. So you need to know, for every one Checkers share, how many Shoprite shares do I need to give? That is basically the question, and we do a calculation. Okay, so that's one aspect, share exchange. The other one is cash. So there's different ways to obtain cash. So you can either fund the cash through the cash in your bank, or you can issue debentures or bonds, or you can obtain a loan from a bank or another financial institution, or you can issue new shares into the market or to certain people, financial institutions, or you can do a rights issue. So those are the different ways you can obtain cash. So you get the cash and then you use the cash to to finance the M&A. The other one we said was a share exchange. There are advantages and disadvantages for both. So we will cover that when we do the revision as well. Okay. Finally, there's something known as, or like I call it, financial effects. So the importance of financial effects is the following. When you want to effect an M&A, when you want to go ahead with an M&A, management of the company, so like the board or the directors, basically, they would come up with a reason for wanting the M&A, okay, the merger or the acquisition, right? There will be some strategic basis for it. So, for example, the vision, mission, and value of the companies, and whatever its strategic objectives are, it wants to expand geographically. So, therefore, they want to do this, or they want to increase. They want to access other markets. When I say markets, it can be from a customer point of view or from a product point of view. Okay, so things like that. So those are strategic reasons for M&A. So management will come up with that. But in terms of the Companies Act, an M&A is considered to be a fundamental transaction. So in terms of the Companies Act of South Africa, an M&A is considered to be a fundamental transaction. Now, a fundamental transaction requires the approval of shareholders. Okay, management can't make the decision. If I remember correctly, shareholders needs to make the decision, and it also needs it requires a special resolution and not a general resolution. A general resolution means at least 50% or just more than 50% of shareholders that meets the quorum must must vote, but the special resolution requires at least 75% of shareholders that meets quorum to vote in favor. So as you can see, they need shareholder approval, but not just any shareholder approval. They need a special resolution, so 75% of shareholders that are present that meet quorum needs to approve. When I say the word quorum, it just means the minimum number of members, shareholders present in order for it to be a valid vote. Okay, so quorum just means the minimum number of shareholders present in order for the vote to be valid. Okay, so it doesn't mean every shareholder must be there. It just needs to meet a certain number, and then 75% of those need to vote in favor. So you can see it's a mammoth task. So in order for management to get the go-ahead, they're going to present to management, to shareholders, the mission, vision, strategic objectives, and all the whys and all the, all the nice stories. But they must also present to shareholders what's the benefit to shareholders. How is it going to benefit me as a shareholder? That's what management needs to show them. And the way you will show them is through what we call financial effects, financial information. So basically, you'll do about 4 to 5 things. You will show them before the M&A and after the M&A. So current versus after. So you will say currently your dividend per share is this, but after the M&A, your dividend per share will be that. Currently, your earnings per share is this. Afterwards, it will be that. Currently, your PE ratio is this. After that, it will be this. So we basically show them dividends per share, earnings per share, dividends per share, earnings per share, PE ratio, market capitalization, and net asset value per share. Those are the typical things. There can be other stuff as well, but those are the 5 numbers that they will look at. So you look, any investment analysts generally look at those numbers as well. Those are the numbers that management will look at. I mean, shareholders want to know, does that affect them directly? The earnings, the dividends, the market cap, net asset value, and PE ratio. Now remember, net asset value, dividends, and earnings per share needs to be on a per share level basis. It's only that way can you compare, okay? Because remember, the number of shares before and after may change. So in order for them to actually let it be comparable, you want it on a dividend per share level basis. So on a per share level basis, so it's easy to do the comparison. Okay, so that is basically the calculations. 3 things: valuations, financing or funding, and financial effects. Now you hardly get that. It was mainly on a CTA level, but I think some years ago they did bring it up. I cannot remember if it is with the MAC 3702 or it was another university, but definitely in CTA. So I will look and I'll see if there is any of that and I'll bring it through, but I just wanted you to get that big picture. So that's all I wanted to cover for tonight. Do you have any questions to ask me? Kayla, Kalsila Ika, Bongani, who is E10088? Who's that?
Faiz, that's my work coach. No, I don't have any questions. That's Fahim, yeah.
Fahim. Fahim.
Yes.
Okay. No questions from your side, okay. Taylor?
Hey, Faiz. I can't think of any questions at the moment.
Okay.
Yeah, thanks.
Kelsey?
No, I'm fine, thank you. I just wanted to ask about the portal. Do you know when we'll be able to access it again?
Yeah, so it should be sorted about this weekend. We just want to see what is the issue. So so the other guys is working on it. They just have a deliverable due for the other client. So they having a look at it. So it should be sorted by Sunday. Monday should be up and running. Okay.
Okay, perfect. Thank you.
Laika, any questions?
No, I think I'm okay. Perfect.
Okay. Bongani?
No, I don't have any question.
Okay, so that's what we will cover for tonight. Remember, from Saturday, not tomorrow Saturday, as in not tomorrow, as in Saturday coming, but the following Saturday, we're going to start our revision program. So I'm going to keep it for a Saturday. I think I'll start at 9. I'm just working through my timetable this weekend, and then by the end of it will be by Sunday. I'll send out, I'll send you a message. I'll just also mention the group just to confirm everything's fine, and then I'll send out all the email requests and a schedule. Why I want it on a Saturday morning, because for us to be fresh, and also I probably have to run it a bit longer, about 2.5, 3 hours, so we can do at least half of a paper. So even though I plan to do 50 marks, I don't exactly cover 50 marks. I may cover about 40 there around, and the other 5 or 4 marks, I'll come now there, Kayla, we will you will leave it out. But what I will do is I'll give you a schedule of which question we're going to cover and which topic. We'll do a quick high-level overview of the various topics, and then we'll cover the question. And then I will also give you homework, where a separate question paper where you need to cover that will be a similar topics that we do. Obviously, the question might not be the same, but the topic will be the same. So, for example, we may cover WACC, but in WACC, cost of equity is calculated using CAPM model. But in your one, it is dividend growth model, something like that. So that one, I mean, won't be exactly the same, but at least from a topic point of view, it will be the same. Okay. So by the end of the revision classes, we at least cover 3 exam papers besides what you've covered through the semester. Okay. Obviously, the big focus will be on 4 topics. It will be on cost of capital, capital budgeting, financial analysis, and then valuations. Okay, valuations, mergers and acquisitions. So that's valuations. I obviously want to get through a valuation question where we cover free cash flow, dividend growth, and a PE. Okay, and when we cover the PE, I'll just show you how you'll do an earnings yield. Because if you can do PE, you can do earnings yield. There's just a slight thinking shift. Okay, and then the other smaller topics, but it can be big if it do come in, and that is sources of finance and working capital. So I'll make sure we cover source of finance and a working capital. The other topics, minor. So if we covered, we covered, but by covering 3 question papers, we would come across dividends and all of those type of stuff. Okay, so that is that's my plan. And then you must do your side. Like I said, for those that submitted to me, I'm almost done marking, and then I will provide you with feedback. Kayla, you had a question?
Yes, I just want to, I know it's a bit silly, but is the website and the portal the same thing?
So that was not a silly question. It's the website is like what I see it. My IT guys don't see it this way. So the website is what I just, when you say www.eduons.co.za and whatever comes up, I call that the website. The portal is the learning management system, is where you actually log in. So the website is running, but there's something, I see some of the CTA guys also having a similar issue. So when you log in with your student details and you open up into that, where all the notes and stuff is,
Yeah.
some people are having problem over there. So that is what we're checking out. So yeah, so no.
I must say, I have access to it completely.
You have access to it. Okay.
Yeah.
So these are, I think, only a certain few people. So I'll just check your one, Kelsey. That's strange, but I'll check. Maybe I must go to your profile and see whether there was a specific limit given. Then I'll just remove it, because that I thought it was maybe on a course level. So maybe that is why the IT guys is not finding too much issue at the moment. But I'll go have a look. I'm gonna have load shedding now, so either after load shedding or tomorrow. Then I'll just confirm with them. But they said they are checking it out. Okay, but it should be sorted by this weekend, Monday for the latest. Okay. So I will send you guys. I will send I'll send out a notification out later, not later, this weekend regarding the plan for the revision classes. So we're gonna at least have 3 classes, at least 3, because there's 3 weekends before the 28th. Because I know you're writing between the 28th and the 16th. So I plan to finish by the 28th, but if there's still another weekend before, during that period before you write, we will continue up until you write, but by every Saturday. But the plan I'm going to send you is for 3 weekends, 3 Saturdays beginning next week. Okay. And then if there's more time, we will have some more time. And if you guys still feel that you need some more lessons, then we'll shift in shorter lessons on a Thursday. Okay. But the plan is Saturday morning, we're going to start about early, maybe like 8ish or something, so we can end off nice and early and you can go study further. Okay, so you don't have any questions, then you're good to go. I will send out this recording by tomorrow. I won't be able to do it tonight because I'm getting load shedding in the next few minutes. Okay. Okay, bye-bye guys. See you. If you don't have any
Fine.
questions, you're good to go.